John Abernethy, thank you for speaking with Financial Review TV. There's been a bit of a lack of discussion about debt of late. It was a big concern leading into the global financial crisis, but it seems like the worldwide solution has actually been to go into more debt rather than go away from it. Are you concerned about this?
Yeah, I'm concerned. The amount of debt around the world with governments has been added to. So we went into a recession with debt. Governments other than Australia, if you look at United Kingdom, European governments, Japanese and American, actually had debt going into this recession. And they've added to that debt during the recession, which was necessary. There's two reasons. One is we had unemployment, so taxes go down, tax receipts, and then there's stimulatory expansion programs, about 5% of GDP across developed countries. So we're now running deficits of 10%, and that's added to the debt of the developing countries of the world. And the G20 for the last 6 months has told those governments, keep on spending, don't stop. So it's not going to stop until at least March, April next year. So the debt load is increasing and it has to be paid back in the future.
So who is buying US government debt at the moment, and is this changing over time?
Right. Well, interesting numbers. The US government's issuing about $100 billion of debt a month. That's new debt. That's before their rollover debt. About 50% of it's going to offshore investors, non-US investors, and about half of that to 60% of it's going to Japanese and Chinese governments. The recent figures in September, though, showed some changes. The Japanese continued to buy American debt. The Chinese slowed down dramatically their purchases in September. We don't know whether that's a change in policy or what it was, but their breach was filled by the United Kingdom, which is a bit hard to believe, but they bought about $20 billion of debt in September. So $100 billion of debt issued September, $48 billion went to foreigners.
Are there still concerns of debt markets being crowded out by all these government bonds?
Yeah, well, if you start projecting out 4 years, and the governments have made projections, if you can get that from OECD, we're looking at the debt of developed countries exceeding $25 trillion by 2014. So that's a dramatic increase from where it is now, sub 20 trillion. So there's going to be continued increase in debt, and that's an issue for debt markets in the future. Particularly, we've got to work out which corporations will not get access or have difficult access to debt because they're not rated in about 4 or 5 years' time if the debt is not brought back under control.
I think a forgotten element of this debt problem is the levels of household debt, which rose sharply before the global financial crisis. Yeah. How have things trended since then?
Yeah, not good. Australia went into this crisis with one of the areas where we had a lot of debt was household debt. In fact, we were only second to UK in terms of our ratio of debt to income. Australia's household debt's now about $1 trillion. Australia's household income is about 600 billion. So the ratio is about 150%. UK is 160. United States is about 120, 130%. So we have a worse ratio there than America. Now, debt has come down slightly in the last 12 months, and that's natural because we've had a recession, people are scared, or they're coerced into paying back debt. Now we're getting commentary that Australia's going to grow again. It's encouraging people to go back into debt. Debt is cheap. The central bank is trying to tighten, but they can't tighten quick enough to encourage people not to take on more debt. Once people are confident that they'll keep their job, they start spending. We get Jerry Harvey's comment, this is going to be a great Christmas. Well, it's not going to be a great Christmas where people spend income. It'll be a great Christmas when people start going back into debt.
So it doesn't sound like we've learned a lot from the days of before the global financial crisis, and it seems like we're being funded a lot by offshore debt.
Yeah, we have been. Now that debt is just rolling over. I'd say as banks write new debt, they're really replacing old debt. I don't think that debt's going to expand, and in fact I think the Australian government and APRA and the central bank actually want Australian banks to reduce that debt, but they have to replace it with local savings, and that's going to occur because what's happening in Australia, we have an ageing population. The ageing population are naturally savers, so that goes into superannuation and into the banking system. So we do have growing savings. However, as we bring in 300,000 people through immigration, they tap on it and they borrow. The question now is, can we generate enough savings to meet the borrowings? Okay, so that's the short-term problem. After that, we've got to look at, can they afford to pay it back and can they meet interest repayments?
One thing that works in tandem with this is house prices and I guess relative affordability and what people are doing in terms of how much they're borrowing to finance houses, most commentators agree at the moment that there is not a house price bubble, even though house prices have risen quite strongly this year. Do you agree with that?
No, well, there is a bubble because we've had a recession and prices have gone up. Okay, and the reason prices have gone up because there's about 4 factors. One is we're immigrating more people than we ever immigrated before. We have population growth naturally, one of the few countries which does in the Western world. We have a low interest rate policy. We have a banking system which allows people to access credit with low deposits. We have a government which has given first home buyer grants, and we have a housing asset market which is capital gains free. Now, if you put that all together, you have the ability to generate a bubble. And it requires more than putting up interest rates, it actually requires regulation.
You're of the view that the Australian economy's fortunes are very tied to that of the US. What happens if the US doesn't recover in a hurry?
Right. Well, what we're watching as fund managers is the bond market in America. Now, the bond market in America has been rallying. That means interest rates are falling. Now, just last week, short-term rates in America dropped to 0. That is 90 days or lower. We've got 2-year yields at 7.75%, and we've got 10-year yields at 3.25%. Those yields indicate America is not going to recover quickly. They indicate that inflation is not an issue. Now, if we don't get inflation, that indicates we're not getting much growth, and we've got overcapacity. That means we've got unemployment. That means growth in America is going to be very slow. The only thing that can change that quickly is if the devaluation of the US dollar starts stimulating exports. Now, the devaluation of the US dollar is not occurring against their major trading partner, which is China. The Chinese are pegging, and that is causing the deflation in America because the Americans aren't getting the inflation imported out of China because the Chinese currency is not revaluing. So our outlook for America is slow growth. Their engagement with China is staying at a lower level than it could be because the Americans aren't getting a devaluation, so they're not growing quick enough to grow their economy. So the outlook for America, and therefore in some parts of Europe, is not good. Slow growth. Australia, however, is decoupling from that and coupling up with China and to a lesser extent Japan. So we are now looking for the Chinese local economy to start growing as they bring their workforce from agriculture to industrial. Now, that's the middle class development, and that's what the Chinese government's trying to do, trying to get those people to come into an economy and start consuming, and that will replace the American consumer.
Our share market takes a lead from the US primarily, but we've got all these other dynamics coming in through China and the other Asian economies. What's your outlook then for the Australian share market for 2010?
Right. Well, I go back to my comment on America. At this point, the Australian market's driven by sentiment out of America because that's 30% of the world's GDP. So at this point in time, we can't ignore it. We expect America to grow slowly next year, some sort of recovery. Recovery will quicken if the Chinese revalue their currency. So at the first sign of that, we get more confident. Until that happens, we expect very low growth in America and Europe and Japan. Okay, so that's 60% of the world, not growing much. China will grow faster than that because they've got government stimulation and they've got that emergence of the middle class who are going to consume more. So that's a great development for Australia. So we get positive from China, not so much from the rest of the world. That means our growth will be good or better than the world, but not as good as it has been in the past, and growth won't be sufficient to bring down unemployment. So we've got 2 or 3% growth next year, okay share market, interest rates beginning to go up again. That looks to us like a share market which is going probably broadly sideways.
John Abernethy, thank you for joining us.
Thanks.